Welcome to our regular 6-minute strategy summary from me, Guy Monson. I spent the last month thinking about how to protect portfolios as interest rates ratchet higher, equity leadership narrows, and geopolitics descends into walled gardens led by either the US or China. 3 areas particularly worry me. First, as I've said repeatedly on these programs, the concentration of US equity performance in a handful of AI-led US supercaps is probably without market precedent. The narrowness of the leadership likely exceeds, for example, even that seen across the infamous Nifty 50 growth stocks of the late 1960s and 70s. Second, monetary policy around the world continues to tighten on all fronts. Yes, global interest rates are close to peaking, but central banks are only now starting to run down their colossal balance sheets, a largely untested process. Finally, I'm worried about restrictions on free trade between the US and China-centric worlds, and the rapid rise of industrial policies which blatantly favour domestic markets. In other words, the continuing march of deglobalisation. In the slides below, we'll discuss this further and look at strategies that can mitigate some of these challenges across your portfolios. So let's begin with my worry number 1, US equity concentration risk, and it's something we've talked about often in these sessions before. In the left-hand panel, you can see our familiar slide of the total return of the S&P 500 for the year to date, and those gold bars representing the contribution from the 10 largest stocks, led by the AI-rich tech names Apple, Microsoft, Tesla, Nvidia, Alphabet, Amazon, and Meta. Not only did they dominate returns, but on the right-hand side, you can see they did it with remarkably low risk. While bond volatility has soared, thanks to interest rate uncertainty, equity volatility has continued to decline, and at 14.4 is well below the 5-year average. In other words, strong returns and low volatility, a very attractive combination. It reminds me of the Nifty 50 back in 1972, where these names were such high quality and such low volatility that people called them one-decision stocks. You didn't have to think about buying them. The top 10 names were IBM, Kodak, of course no more, GE, Sears, Roebuck, Xerox, 3M, Procter & Gamble, Coca-Cola, Avon Products and Johnson & Johnson. Now these were very high quality companies, but they were actually poor stocks because they got overvalued at 43 times earnings, and they underperformed the index for nearly a decade afterwards. Sounds familiar today? Well, the US Global Technology Index trades on 40 times historic earnings. And again, some of those companies could run into a valuation trap. How should investors react? Well, use attractive and expensive US tech stocks to switch into lower valuation opportunities. In last week's call, we looked at Japan, and particularly the cheapness of the index of 15.6 times forward earnings and a price to book of just 1.2, that means you're paying little more than the net assets of the company. It looks particularly attractive against the US S&P 500, trading on 4 times book. And as you can see on the left-hand panel, nearly 30 years of deflation is close to coming to an end as wage negotiations rise sharply and more companies at last are able to price effectively. And of course we like the thematic opportunities, robotics, connectivity, smart buildings, autos and electrification, all key features of the Japanese market. Let's now move to risk number 2. How do we guard against tightening liquidity conditions globally? Well, my worry is this is happening on 3 fronts. Central banks are shrinking their balance sheets, as you can see in the left-hand panel. This is a largely untested process, so-called QT. In the right-hand panel, interest rates have risen very sharply around the world, and commercial banks themselves are much more picky about their loans, as you can see from the Senior Loan Officer Survey. How to react here? Well, again, begin to diversify some of those successful, highly priced equity names back into the problem asset class of the last 3 years, bonds. Global equities have outperformed by an extraordinary amount, rising 33% over the last three years, against a fall of 30% for UK gilts. On the right-hand panel, you can see some attractive yields here today. UK corporate bonds yielding now 6.1%. That's attractive for investors, if indeed UK inflation comes back to target of 5% by year end and somewhere between 2 to 3% by 2024. So begin to consider switching expensive equities into cheap bonds. Third and finally, walled gardens, the fragmentation of trade into a China-centric and US-centric world that so dominates geopolitics at the moment. In a very good speech to the South African Reserve Bank conference, Geeta Gopinath at the IMF highlighted that trade restrictions imposed annually have gone from around about 1,000 in 2019 to 3,000 today across goods, services and investment. Perhaps even more serious, big subsidy programs like the US Inflation Reduction Act, the biggest piece of climate legislation in US history, are very blatantly in favour of domestic companies, so-called trade opportunities but with restrictive subsidies. And this is beginning to fragment the world and fragment the underlying earnings opportunities. What do we do here? Well, ironically, I think tied to that one demand that you know is really central to so many governments around the world, that is a commitment in climate and accelerated climate spend to meet 2030 targets. And the funding in numbers are extraordinary. In the left-hand panel, don't go into all the details, but the latest projections of the cost of the IRA, Biden's flagship piece of climate legislation, has gone from $400 billion to almost $1 trillion as individuals and businesses alike jump on these tax credits. That'll also push up in a big surge in renewables and a change in the outlook for the energy market. So favour climate leaders in low carbon transport, smart buildings, electrification, high carbon transition, food and farming, where you know government subsidies, even if they are in local industries, will flow to those areas. So thank you, I hope it's helpful. I hope it begins to deal with three issues that are on my mind as markets proceed into the fourth quarter. Thank you so much.